The topics and opinions expressed in the following show are solely those of the hosts and their guests and not those of W4CY Radio, its employees, or affiliates. We make no recommendations or endorsements for radio show programs, services, or products mentioned on air or on our web. No liability, explicit or implied, shall be extended to W4CY Radio or its employees or affiliates. Any questions or comments should be directed to those show hosts. Thank you for choosing W4CY Radio.
Barry G. Fowler, EA, brings you Tax Talk for You right here on W4CY Radio and Talk4 TV. As an enrolled agent and a national leader in tax resolution, as well as trucker, bookkeeping, and tax planning with over 30 years of experience, Barry will break down taxes, bookkeeping, tax planning, and tax relief for individuals and businesses just like you. So let's have some Tax Talk for You with your host, Barry G. Fowler.
Hey, welcome and good morning. It's great to be here. It's been a fantastic weekend with family and birthdays, baptisms, all the fun we get to do for not just us, but our grandkids and, our kids. And it makes the weekends well worth it, as well as, doing some ranching and working with cattle and the pigs and cows. And then we get to come back here on Mondays and talk about taxes here with you. Not only here, but also we get to be on radio with Ask the Experts a couple times a month nationwide, just bringing information to you to help you in your business, whether you are owner, operator, truck driver, or whether you're self-employed individual out there, or you're just W-2 and you're working on your own taxes, or even if you're using somebody. It's good to know what's happening in the tax law and what's going to change. Each year the IRS makes adjustments that's going to impact your taxes, your retirement saving contributions, and other financial thresholds that are out there. So staying updated on these changes, it can help you get a head start for planning and making the most of, the benefits maybe even that your company offers or that you're going to offer as a self-employed individual or as a owner operator out there. So let's go into some of the major updates for 2025 and how they may impact your financial strategies on what you're going to do in your life and your financial situation. So some of the notable changes for 2025, the standard deduction, for single taxpayers or married taxpayers that are filing separate for 2025, the standard deduction is going to rise to $15,000. That's a $400 increase from 2025. Doesn't really seem like much with inflation out there, but every dollar does help. For married couples filing jointly, the standard deduction is going to rise to $30,000. That's an increase of $800 for 2025 over 2024. For heads of households, the standard deduction is going to be $22,500, and that's for tax year 2025, and that's a $600 increase there. Now, the marginal tax brackets. Now, we have tax brackets that are going to range from anywhere from 10% to 35%. 10% is going to be for incomes of $11,925 or less for single or married filing separate. And it's $23,850 for married couples filing joint. Now, remember, the thing about the marginal rates and the marginal tax brackets, so if you're a married couple filing, that first $23,850 is going to be taxed at no more than 10%. And then you're going to move to the next tax bracket. So every dollar over that $23,850, again, for married filing joint couples, it'll be taxed at 12%. And so that's going to go all the way up to the next bracket, which is the 22% bracket, which starts at $96,950. So the way brackets work is that first $23,850 is taxed at 10%. The dollar amount from the $23,851 all the way up to $96,950 is taxed at 12%. And then the next bracket is that 22% bracket, and that's going to go all the way to $206,700 for married couples filing jointly. Now you can divide that in half to get to singles, and you can, for married filing separate, each of those brackets are going to be pretty much half of, what we're talking about for married couples. The next bracket from 24 goes up to 32%, a big 8% jump. And that's going to be incomes over $394,600. So there's basically $188,000 before the next bracket. And then you take your next big jump to 35%, and that's over $501,050. And so everything above that will get taxed at 35%. And then you've got the top marginal tax bracket is going to be 37%. And it's going to be, married couples are going to be where it's over $751,000 to $600. If you are single, that actually starts at $626,350. So that one is not a half of what the married couple files. Those single taxpayers get an advantage of having a greater jump to get to that 37% tax bracket. So, you got to keep these things in mind. It is not where you jump from one bracket to having everything taxed at the highest bracket. So if you do move from, let's say, you're making $200,000 and all of a sudden you move up to $220,000, the only difference is going to be from that $206,000 going up. So, you don't take a huge jump to the 24% tax bracket for everything, just the next step above where that marginal rate starts. So, you'll be taxed at everything at the lower rates and the lower brackets as you move through. Alternative minimum tax. We don't talk much about it because it's sometimes harder, to hit these days to hit the alternative minimum tax. For the tax year 2025, the exemption amount for unmarried individuals will jump to $88,000, $68,650 for married filing separate, and begins to phase out at $626,000. And then for married couples, the exemption amount increases to $137,000 and phases out at $1.2 million, $52,700. Like I said, we don't usually hit too much in alternative minimum tax anymore. We're hoping with what they're planning in Congress at the moment that I just read, this morning, is hitting the ground running quickly to extend or make permanent the Trump tax code, which is a good thing for everybody to help somewhat simplify the taxes. I remember when they were first talking about the Trump tax code and trying to simplify everything to be a postcard, and ended up being like 3 different small sections, and now it's back to the full forms. We would all love to see it get a little more simplified for, lower income people. It's always going to be more sophisticated for higher income people. But the standard deduction, with today's mortgage interest rates and everything, more and more people, and they refinance their homes or bought new homes or sold their home and bought a new one, are more likely to get over that standard deduction, as well, which makes charitable contributions more deductible. The one change that I also seeing that they're looking to make is possibly doing away from the limitations for state and local taxes, which is capped at $10,000 and not been incremented for inflation or anything like that. So, that has stood at the 10,000 since the tax code was passed back in 2016 and effective in 17. So we got to keep those things in mind. Now, if they make these changes, then depending on what state you're in, depending on what your income taxes are, what your property taxes may be, that could impact whether or not you're going to be able to do more than what the standard deductions would be, because those things would come into play. If you're in one of the lower tax states, those things may not affect you as much. We're going to take a short break. We're going to come back, talk about earned income tax credits, your retirement changes, and maybe your flexible spending accounts and medical savings accounts. And we're going to be right back after this.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. If you owe the IRS or are going through an IRS audit, don't go at it alone. Call Taxation Solutions Tax Relief at 888-930-1016. We are your solution for IRS debts, audits, back taxes, garnishments, liens, and levies. Whether you're an individual or business, you need a solution and a strong, aggressive tax resolution. Don't let the IRS walk all over you. Stop the IRS now. Call 888-930-1016 or go to taxationsolutions.net now for a free, no obligation consultation. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. We love to get questions, so you can text us your questions. We'll answer them here on the air. So feel free to text us, and we'll get the questions on air for you and answer those as well. Somebody asked a question. Let's see who this was. Chris asked about personal exemptions. What is the personal exemption amount? Well, personal exemptions were eliminated as part of the provision of Tax Cuts and Jobs Act of 2017. We haven't had personal exemptions since then. So in 2025, they're going to remain zero as they are in 2024. A good question. Not many people think about those things, but those are some of the tax laws that we had in effect, back prior to the Trump tax cuts for the 2017 Act. And, they did increase the standard deductions and things to help offset a lot of the things that they were doing and change the tax rates and the brackets as well. So talking about, changes and how they modified, tax code and the changes they make from one year to the next, such as things like earned income tax credits, which are important to a lot of people. For qualifying taxpayers, if you have 3 or more qualifying children, the tax year 2025, the maximum earned income tax credit is going to be $8,046. That's an increase from $7,830 in 2024. The revenue, procedure manual is going to contain a table providing, maximum earned income tax credits for other categories and thresholds and phase outs. They are all going to go up, a little bit for inflation, that cost of living, which never keeps pace with actual inflation. Flexible spending accounts, the cafeteria plans for health savings. Beginning in 2025, the dollar limitations for employee salary reduction contributions to these health flexible spending accounts is going to rise to $3,300, increasing from $3,200 in 2024. These are cafeteria plans that are going to allow you to put money away pre-tax. And they also, most of these plans nowadays allow the carryover unused amounts. This maximum carryover in these accounts are going to be like $660 instead of $640 from 2024. So if you've got it, you need to use it because they're only going to allow you so much of a carryover. So $640 is left. You can carry that over to 2025. Unlike health savings accounts, so if you're contributing to an actual health savings account because you have a high deductible health plan, that amount that you have in there can carry over and continue to increase year to year. We're going to go over health savings accounts here in a little bit on how you can use those to continue to save and put money away pre-tax, especially if you're owner-operator or self-employed individual, how you can use these plans to your benefit. Medical savings accounts, these are those that have self-only coverage. The plan must have an annual deductible of not less than $2,850. It's a $50 increase from the previous year, but not more than $4,300, an increase of $150 from the previous year. Maximum out-of-pocket expense amount rises to $5,700 from $5,500. So you can use these great medical savings accounts to do this and help save your money. Now, remember, in these health savings account or these medical savings accounts, you can roll this money over year to year, and you're not really worried about use it or lose it rules. If you contribute the max every single year into these accounts, the really nice part about it is you can accumulate quite a bit of money. And if you're using the investment feature that may be in some of these accounts, you can also accumulate quite a bit of money so that when you are retired, you can use that money then if you have any major medical hitting your deductibles and so forth and so on. And it's money that accumulates out there tax-free. And as long as you're using it for health, then it again comes out tax-free and there's no tax on it. So you're not having to use your retirement accounts to satisfy deductibles or co-pays on your health insurance, especially if you're getting some kind of medical procedures done. The estate tax credits, and this has been a big topic of discussion. You see a lot on the internet that is saying, hey, let's do estate tax planning for 2025, 2024, and how best you can make use of this. People have gotten to the point where they're scared that the tax law would go back to the previous tax law. And how do you make the best use of the current laws we have in place for estate planning? And that's using the estate value limits that you can pass on that is not taxed. So estates of descendants who would die in 2025, you're going to have a basic exclusion amount of $13,990,000. That's an increase from $13,610,000. if you were to pass away in 2024. The purpose of estate planning, and especially, if you're into land and things that have gotten extremely high in value, to be able to pass that land on in farming and ranching, sometimes that land became incredibly high value, and it's really hard to pay estate taxes on, and people were losing land. Well, this allows you to pass on almost $14 million in estate value to your heirs to continue your legacy and what you're passing on to them, and not have to sell it and pay the tax on it. Speaking of which, as well, is if you've got money in 401ks, IRAs, and you were to pass away, you could have direct beneficiaries, and they would have a period of time to pull that money out. So if you have stock in a IRA or 401k, I'm going to use a great example. My mom and dad had stock in McDonald's, but that money was sitting into a IRA, and that was earmarked for their grandchildren, and passing that money out to their grandchildren, the shares of stock. Well, the shares of stock were sitting in a pre-tax account. And once you pass this to the grandkids, and they would be required to take distributions out of it, and they would no longer hold that stock because they would have to sell the stock to get the money out and pay it. So we actually arranged a plan with our parents for estate planning to be able to move these shares of stock out of this pre-tax account with their required minimum distributions to put it into a after-tax account, so that when they pass away, they are able to pass along the shares of stock in McDonald's to each of the grandkids, based on the number of shares that are in there. So you kind of got to look at your estate plan and, what are your intentions? What are you trying to do? My mom is a lover of McDonald's, and she's always loved it for as long as I can remember. And so them passing on these shares of stock means a lot to her. So, we were doing estate planning to help her make things work the way she wanted to when she passes away. Hopefully it's a long time from now, but we're prepared for that part of her estate, to move on. There's some other annual increases, such as the annual exclusion for gifts. It increased from to $19,000 per calendar year. That went up from $18,000 in 2024. Again, if it is mom and dad or grandparents, grandma and grandpa passing money to grandchildren or their sons or their daughters, it's $19,000 each parent to each of the people they're giving to. So if you were giving money to both things, you can double that to $38,000. When we come back, we're going to continue talking about changes in the 2025 tax code for cost of living or inflation, what the IRS is doing. We'll be right back after this.
We have only scratched the surface of today's show. Please stand by, as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Trucker Tax Tools handles all your bookkeeping and taxes, no matter what level trucker you are. Life on the road can be taxing, but that doesn't mean that your wallet or time with your family should suffer. Trucker Tax Tools makes your life run smoothly. Go to truckertaxtools.com for a free guide that will give you the tools to never worry about your taxes again. Call Trucker Tax Tools 877-966-2477 or go to truckertaxtools.com now and let the experts keep you trucking. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. We're very thankful for the truckers out there on the road, owner-operators, moving the goods across the country so that you and I have items we need that are necessities, even luxuries that we may have. It takes a trucker to get them from one point A to point B to get them to where somebody can sell them to you. And so we do appreciate all the work that they do for you and I out there. We were talking about the IRS and the changes that they make and the adjustments they make year to year. And we're going to talk about how it impacts retirement savings and your contributions to your retirement accounts. 401ks, 403bs, and their contribution limits are going to increase. Now, this includes, not just 401ks within, a company that maybe you're a W-2 employee, but it could be solo 401ks where you're an owner operator and running your own business. You can use a solo 401k to maximize retirement contributions and decrease taxes as well. And so for 2025, you can contribute up to $23,500 to a 401k or a 403b plan if you're under 50. And so that's up from 23,000. So you're going to 23.5. Now, catch-up contributions for those over 50 is going to stay at 7,500. And employees, age 60 to 63, you can contribute additional catch-up amount to $11,250. So if you haven't been contributing and you need to contribute more, this is the time to start getting those contributions. We work with a lot of self-employed people, especially owner-operators and truckers. And that's one of the things people don't talk about enough is what are we going to do for retirement? When you're self-employed and when you're an owner-operator, you first need to think about yourself. You should be contributing for yourself before anything else gets paid. Make sure you're making that contribution so that you do have money set aside to retire. Not every self-employed person wants to be continued being self-employed until their 80s and 90s. Not everybody wants to be driving a truck until their 80s and 90s. I know some do. And some I've talked to said, hey, yeah, this is my retirement plan. It is my truck and what I want to do. Let's set yourself up for a better retirement, to be able to step aside and do that 401k or the solo 401k. We need to look at everything that's out there. What are the combined employee-employer 401k limits? The total combined limits for a 401k or a 403b plan are going to be increasing as well. For those under 50, the new cap is $70,000. While for those over 50, contribute up to $77,500. And if you're in the 60 to 63 age bracket, you can max out at $81,250, including those additional contribution catch-ups. So you can see 401k plans if you're self-employed or owner-operator, truck driver, those limits can be very, very high. Now, when you are running your own business, you have to watch out because if you have employees, what you do for one, you have to do for everybody. So when you're doing and talking about 401k or 403b matches and employer contributions, you've got to make sure you're talking with your rep that handles your 401k account to make sure that you're doing it correctly and that you are treating every employee identically and not falling to the discrimination rules that are out there. Now, if you're a solo person out there working in your business, hey, maximize your 401ks. Get that money sitting out there. Maybe you do some of them as a regular contribution. Sometimes you may do it as a Roth contribution as well, and save yourself taxes, in the future based on today's tax code. Now, the other type of plans that are out there is the self-employed pension plan, simplified employee pension plan. Those limits are increased to $70,000 in 2025, up $1,000 from 2024. Your traditional and Roth IRA limits, there's going to be no changes here. Your contributions are going to remain at $7,000 or $8,000 if you're eligible for the catch-up. So you're not getting as much in the way of contributions if you're going the traditional or the traditional Roth IRAs that are out there. So if you are self-employed, take advantage of setting up a simplified employee pension plan or maybe a solo 401k and maximize the contributions going into it. But if you're a W-2 employee and sometimes if you have a pension plan or plan that you're contributing to, you may be able to contribute to these traditional or Roth, but most likely you will not. And but if you're don't have any plans available to you at your employer, definitely make that contribution to your own IRA, whether it's Roth or traditional. Some of this will depend on the tax bracket you're currently in and what's going to be better, for you. Because if you're in a low tax bracket, you may not want to do it as a traditional, put it in as a Roth contribution. And therefore, later on in life, you're not getting taxed when you pull it out. And especially if you're young. And this account has a lot of time to accumulate. The more you put in as you're young, the more that will accumulate and grow to where it becomes a lot more worthwhile to be in a Roth versus traditional, provided, of course, they don't change tax rules. There's always the threat of that. Health savings accounts, these always remain a fantastic tax advantaged way to save for healthcare expenses. We talked about this a little bit with the medical savings accounts, but the health savings for 2025, the HSA contribution limits are increasing from $41,500 for singles to and $8,300 for family plans to $4,300 and $8,550 respectively between the two. So your singles are going from $4,150 to $4,300, and your family plans from $8,300 to $8,550. So those are really good. Now, if you're over 55, you can add additional $1,000 to that to catch up. And again, hey, if you don't use it, you don't lose it. And if you don't use it, you continue to accumulate into that account. And as long as you use it only for medical, it's a tax-free distribution to you. And you also got to remember that, hey, you're not getting a deduction on your tax return for medical expenses. You got to get over 7.5% of your adjusted gross income before it even starts getting deductible. Then you got to get over your standard deduction. Oh my, those are some high hurdles to get over. And using a plan like your HSA takes it and puts it in pre-tax money and not get taxed on it as long as it's only used for medical. And every HSA plan does have investment features to where this money can sit there for years on end. And if it's invested, and it's usually mutual funds, and it can be conservative, you continue to grow and grow and grow over a period of time. So, take advantage of those things as well. We get a lot of questions on Social Security. What's happening in Social Security? Social Security always does a cost of living adjustment. The cost of living adjustment for 2025 is 2.57%. 2.57%. And that's reflected because there's been some cooling of inflation. Although we all still are feeling the effects of the inflation that we've had over the last 4 years, the adjustment in cost of living for Social Security, because the adjustment for inflation was not as high. Social Security be taxable income. Where am I going to stop being taxed for Social Security? In 2025, it's going to go to $176,100 of income. That's up from $168,000 in 2024. That's where the thresholds are. So we definitely, looking at a significant increase in how much is going to be taxed. That adds roughly another $1,500 in taxes, $750 each between you and the company. Hey, as I promised, we're going to come back from our break, and we're going to talk about tax relief. You owe taxes to the government. You have tax debt, or maybe you just owe way more than you could possibly imagine. Well, we're going to talk about tax relief, how you can put a solution in place to help your family and your situation recover from such major debt and collections from the IRS. And we'll be right back after this.
We have only scratched the surface of today's show. Please stand by, as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Stop spending time doing paperwork. Go to truckertaxtools.com, a solution built specifically for truckers. Truckertaxtools.com makes your life run smoothly. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. Talk about tax relief. The hardest part that people go through is owing the IRS money. IRS being the biggest, largest, baddest collection agency in the world, really can cause havoc in your life. From your spouse being on you because you haven't dealt with your tax problem, to maybe you're an owner operator, you're a truck driver, and a lot of people that we put solutions in place for our truck drivers out there. And, the problems happen. You got tax debt because you didn't have time to deal with your taxes and you got behind. Or maybe you didn't have a financial advisor that advised you that you should be paying estimated tax payments and you should be making those every quarter. And now you have tax debt. What do I do? How do I do it? It's longer than we can talk in the last segment of the show. We need to dedicate a whole show to this. But first steps is realizing that you've got to deal with it. That is the first step. Identify it and realize I've got to deal with it. Whether you think you owe the money or not, you're getting those nasty grams from the IRS. You're getting those love letters that they love your money and they want your money. You've got to find a way to man up and say, enough of this. I've got to find a solution to put in place. You have options, and it's sometimes it's dealing with the IRS yourself and getting on a payment plan and just, sucking it up and making the payments to them on a monthly basis. Whatever they ask for, you just make sure that you make that payment. And whether you can afford it or not, you agree to it. Sometimes you, as we say to our kids, when they don't like something and they've got to deal with it, suck it up, buttercup. Let's move on. That may be the solution for you. The IRS does offer, other options and other solutions. It could be non-collectible status that, maybe you're just retired and you're on Social Security and you have no other income. And, we can go in and show the IRS that you should be in a non-collectible status, fill out all their paperwork and say, hey, look, Jane Doe here doesn't have the money and they should be in non-collectible status, and here's the proof. And we have to go through and prove it to them and wait for manager approval in those cases. Sometimes it's easy to do, and other times we've got to really jump through a lot of hurdles. That maybe you've got money sitting in a 401k or IRAs, and you need the money to live on, and we've got to prove that, hey, this is money that you need to live on over the next 20 years of your life, and you can only pull this. Or maybe you are a government employee or former government employee and you're getting a pension, and or you've worked for the railroad or teacher, and you only have so much coming in, and we've got to go through and prove that income is needed and required for you to make it, or you can't pull it out, or there's so many penalties out there that pulling this money out makes it a very much a huge burden to you because of your financial situation. Other times, again, you got to be just straight on a payment plan. The client we were just working with here recently, they owed about $80,000. But they also had a house that was, free and clear, had no other debts besides maybe a car payment. And, per the IRS, they can afford to make the payment. So what is the alternative? The alternative is getting a hold on their account and getting them the opportunity to get a loan on the house, mortgage, which the interest rate would be cheaper and less penalties, and the payment could be lower than paying the IRS and doing a full pay with the IRS. The IRS wasn't going to let them do the offer and compromise because they have enough assets to fully pay the debt. So, we've got to figure out other arrangements with them, abating penalties and getting some of this other stuff reduced because of the reasons we could give them. The debt was incurred, and therefore, reducing the penalties for them on the years that they have taxes out there. And the good news is in our case, if you came to Taxation Solutions for your tax relief, when we do penalty relief, we don't charge you unless we are 100% successful. So whatever we're going to get reduced, we're going to only charge you when we get that reduction for you. There's no charge if we're not able to reduce or remove penalties from your account. But when we do get them removed, then we get rewarded, just like you get rewarded with the savings. And that's sometimes the beautiful part in helping you put the solution in place that you need to save money. Now, offers and compromise, we hear this on the radio. Are they the right way, the right place to go to solve your tax problem? Not for everybody, because not everybody qualifies. You've got to meet the criteria for getting an offer and compromise. And, that criteria is income, assets, expenses, and then meeting also the IRS's criteria for what expenses you can actual deduct. Because just because you have a extremely high mortgage payment doesn't mean you're going to qualify for that expense. You've got a national standard that you can't go above for housing and utilities. Same with, clothing, food. All these things have limits on it. and you got to comply with those limits. So if you need help and you want a solution to your problem, call Taxation Solutions Tax Relief at 888-930-1016. Again, 888-930-1016, or go to taxationsolutions.net. Do it now for a free, no obligation consultation. Call us, 888-930-1016. We want to help you. We want to help you find the right solution for your place. Hey, the fun part we get to deal with in taxes is making people happy by putting that solution, getting the IRS off their back, or maybe finding ways to reduce your taxes. And this is what we get to talk about in this show. Tax Talk for You is all about you. It's about your taxes, whether you are self-employed, whether you're an owner-operator, whether you're running a small business, or maybe you're running a larger business. Maybe you're running a trucking company with 5 trucks, 10 trucks, 20 trucks, whatever it is. This is the place to be, not just for you, but for your family, for your friends that are out there running a business as well. If you're an owner operator, we always tell you, bookkeeping at the fuel pump is exactly what it's worth. Almost nothing. They're not bookkeepers. They're not tax people. We are. When you're talking about bookkeeping, you're talking about taxes, you're talking about your business, come here. Come to Tax Talk for You. Go to taxtalk4u.com. Subscribe. Go to our Facebook page at Tax Talk for You. Get in there and stay abreast of everything that's happening in taxes, tax relief. Maybe you don't have a tax problem, but maybe somebody in your family does. Refer them over to taxtalk4u.com. Get them to subscribe so they can get the information that's out there. We're coming up with a great playbook on how to beat the IRS. If you got a tax problem, that playbook is going to come out shortly. When we get that playbook out, it is going to be something that you want to get your hands on, especially if you owe the IRS money. So that's why you got to stay connected at taxtalk4u.com. Now, next week, we're going to talk more about, tax laws, how it affects you, how it affects your business, and go through in detail a sample case of offer and compromise in case you want to do it yourself. Now, this is something you might want to hear. If you owe the IRS $10,000, $20,000, $50,000, $100,000, you've got to connect here to hear the details on how an offer and compromise is done. And what are the things that the IRS is looking for? What are the things you've got to provide to the IRS, and how do you have to provide it? And we get to talk about all these things in detail with you so that if you are a do-it-yourselfer, you can get it done. Hey, things that change in tax laws every year. New Congress, new laws. New administration, new laws. It doesn't matter whether you are a W-2 employee, self-employed, small business owner, large business owner. You've got to deal with what tax laws are out there and how to best put the tax laws together to work for you so that you can save money. And that's what it's all about. Saving money on taxes, keeping more money in your pocket. So make sure every week you connect right here at Tax Talk for You. We will see you every Monday, 10 a.m. Eastern Time. Again, connect at taxtalk4u.com. Thank you. Have a great and God-blessed, glorious week.
Are you an individual or business that wants to understand taxes and how they affect you? Are you looking for specific tax advice for self-employed, business owners, and truckers? Are you behind on taxes and your bookkeeping? Are you dealing with the IRS and ready to have some relief? Then you need Tax Talk for You, hosted by tax and trucker expert Barry G. Fowler, EA. Tune in 10 a.m. Eastern Time every Monday right here on W4CY Radio and Talk4 TV. Don't forget to check this and past episodes at taxtalkforyou.com. See you next week at W4CY.com.